Hi, I'm Jamin Yee, and on behalf of my colleagues at Roland Yee, welcome to another edition of our Money Manager interview series. A foundational part of our investment strategy is due diligence. Our process begins with the 4 Ps: performance, process, philosophy, and people. In all the years I've had the opportunity to meet directly with investment firms, I've learned the most important part of money manager research is people. In the end, after all the analysis is conducted, we want to answer this question: do we trust our clients' money with these people? I hope you enjoy getting to know some of the managers we utilize and gain some perspective and insights on their respective strategies. Today, we're joined by Jeffrey Sherman, DoubleLine's Deputy Chief Investment Officer. Jeff oversees and administers DoubleLine's investment management subcommittee. He has a popular podcast with amazing guests, ranging from some of Wall Street's well-known strategists to life coach Tony Robbins. He is a regular on CNBC and Bloomberg. DoubleLine is a $135 billion asset management firm that is well known for investing in the bond market. Jeff is going to discuss the economic environment in 2022, including inflation and interest rates. This interview was recorded on January 12th, 2022. The views and opinions expressed here are as of the date recorded and should not be construed as an offer to buy or sell any securities. Such views and opinions may differ from those of Roland Yee Investment Advisors and are subject to change without notice.
How are you?
I'm great. Thanks for doing this.
Yes, it's good to see you, Jamin. Thank you.
So my wife and daughter are not interested in investing. What's a simple way to explain the bond market to them and the importance of owning a fixed income fund or bonds in general?
Well, I think a lot of professional investors would wonder why own bonds in general today, given the low yields and some of the risk out there. But I think very simplistically, it's borrowing, right? And so, do you have the ability to borrow money and to put it to good work? So think about, hopefully you have a house, right? And that house, most people don't go pay cash for. They have to borrow some of that money. Well, why would you borrow money that you don't have? Well, and we call it leverage, right? It's the ability to finance something out. But I think importantly, it's that, you have creditworthiness, you have a job, you have the ability to repay it. But what you want to do is you want to be able to access capital. And so that's really simplistically what the bond market is. It's just people borrowing money, but instead of borrowing directly from a bank, it gets what we call syndicated out, or it gets distributed across a lot of investors. And so there's people that think, Jamin, you're creditworthy, and they're happy to lend you money. It could be Bank of America. It could be JP Morgan, right? Chase. It could be Wells Fargo. It could be DoubleLine, right? That we think you're a great credit. So at the end of the day, the bond market is really just like a big bank that they're out there lending to people. And in order to do so, you just need to be able to understand the creditworthiness of that borrower.
That's a great way to put it. Thank you. So I'll have to make sure my daughter understands that from a credit worthiness perspective, right?
Yes, and you're only as good as your reputation out there. So in the investing markets, we call it your financials. That's what we care about.
All right, shifting to your firm's outlook, what do you see with the economy and the bond market for 2022? And what are you optimistic about and what are you concerned about?
Yeah, well, I think it's going to be another challenging year in fixed income. And a lot of people will say, well, if I go back through history and look at let's say, for instance, the Barclays, it's out of the Bloomberg ag. It was a Lehman ag when I started, but the aggregate index. And if you look historically, it's never had 2 consecutive years in a row on the calendar where you've had a negative rate of return. Unfortunately, I think potentially this year set up to actually break that trend. And the reason for that is that the starting yields on the aggregate are so low, right? That we have a low interest rate environment, and the interest rate sensitivity is very high in the bond world. We call it duration. And so the problem with the Barclays US aggregate today, or the Bloomberg aggregate, is that if you look at it, it has a yield of approximately 2%. And it has an interest rate sensitivity of almost 6.9 years. And so roughly what that means is that if interest rates move upward by 0.3% over the course of the year, the price depreciation of the ag will be greater than the yield on the ag. Therefore, you get the yield, you get the price return together. They would give you that rate of return. So the really thinking about the fixed income market is what happens to U.S. interest rates. That is really the key thing. And the other part, as we talked about with your daughter and wife, is the credit worthiness of the market. The credit worthiness is not a concern to me today in the marketplace because we have lots of liquidity, right? There's been this infusion of capital, whether these are the extraordinary measures that Congress passed to help inject into corporate America back in 2020, whether it's the Fed policies of keeping interest rates low and the buying bonds, the quantitative easing, helping facilitate liquidity in the system. What that means is that corporate America in general is in a good position. So the default risk is relatively benign. So you don't really expect a lot from defaults, but what you do have to play into the equation is, okay, we have the yield, then we got to worry about the price change. That's the biggest variable here. And that's going to be on the path of interest rates. And so as we think about where the economy is, I'm going to weave all this back together. Where the economy is right now, we're going to have one of the best nominal GDPs we've experienced in our lifetimes, right? Or at least in my lifetime, I'll say, in the last 40 years or so. And so what that means is that the economy has been strong. Doesn't mean it will be strong, but it has been. If you look at the forecast for growth this year, I think the consensus is roughly 4% real GDP, not including inflation. And so nominal GDP includes real growth plus inflation. And so what we're seeing is that we think inflation runs roughly in the 4% range as well. So let's take low end estimates. So if you said, okay, low end, we grow at 3 and inflation kind of converges back down, we get it to 3%, that's 6% nominal. That's a pretty good growth rate. I remind you, post GFC, the global financial crisis, until we had COVID, we rarely saw nominal GDP north of 6%. But if you kind of take our baseline, we're talking closer to 8% for real, for inflation. And then potentially there's some upside to that as well. So what that means is the economy is poised to be in a pretty good position this year. And you also have the Federal Reserve talking about raising interest rates, right? They're getting out of their bond buying program. They'll be out of that by the middle of March of this year, assuming the same pace takes hold, which I expect. And then they're going to start raising interest rates. So that interest rate pressure should push yields up across the curve, all things being equal, especially with this growth environment. So what that means is that a passive investor who just goes in and buys the Barclays, or I keep calling it the Barclays. It took me forever to get out of that Lehman, but I'll get out of it eventually. The Bloomberg aggregate, right? What they're saying is that, okay, I don't expect really rates to move that much because I'm not going to be active or do anything around it. So the bond market itself does have some opportunities, but I think it's outside of the Barclays Act. I think I see I did it again, Jamin, I did it again. I said Barclays Act, the Bloomberg Act, right? And what the opportunity set is, it's in things that are not in that index. It's in things like bank loans. It's things like high yield corporate bonds. It's in emerging market debt. It's in parts of the mortgage markets that aren't in the ag. It's part of the commercial mortgage market. It's some of the asset-backed market. So it's these things that are outside of that really referenced index that are the most attractive parts of the market. And why is that? They have greater yield opportunities and they have a lower interest rate sensitivity. In some cases, you're exchanging that for credit risk, a less credit worthy borrower. But again, given the backdrop, that seems like the place to be. So I've answered your question with a bunch of kind of data here. And I said, well, it's going to be bad for bonds, but there's ways to enhance that. And I think that's really what it comes down to in 22 is that it is a good economy. It still is. And the interest rates are too low. They're likely to reset, but you need to be active around the periphery and you need to be able to rotate across sectors of the market.
No, that's great feedback. Thank you. And it kind of makes the case for active investment. Right?
Yeah. And your listeners out there may say it's self-serving being an active manager, but absolutely. I think it's very important right now because there is a lot of that risk sitting within the Bloomberg ag. Nailed it, finally did it right. Within that Bloomberg ag. And it's been a great place to be because interest rates have been declining. That longer sensitivity has been helpful, but you can compose a portfolio that has a similar attributes as that interest rate sensitivity, and you can do it in a way that has higher yield. So how do you do that? You blend different parts of the market together. So without getting into all those details, I think that it's going to be a challenging market for bonds, but I also think it's going to be a tale of two halves. I think it's going to be a strong economy for the first half of the year, and it's going to be a lot more fuzzy when it gets to the second half of the year. We've lost our fiscal stimulus. We've lost some of these supportive programs that have been helping families over the last year or so. And also you have the Fed raising rates, which will tighten policy, which will make conditions a little bit tighter out there. And so when you pull all this together, we're going to have to see how the consumer reacts, how wages materialize over this path, and does lending, contract within there. I don't think it does. I think the banks are awash with liquidity. So I think there's a potential to continue on that trajectory for the second half of the year. But there's a lot of wild cards because of the inflation data that we've seen. And will the Fed act too aggressively to try to combat that inflation?
Yeah, as we talk about the consumer and you mentioned inflation, what are your thoughts on inflation for the next 12 months?
Yeah, as I kind of briefly said in the opening comments, we think inflation runs in the low 4% this year. And if you look at some of the consensus thoughts out there, the consensus that it's in like the high 2s, which I find that a bit perplexing because we can't get to that without really some collapse in economic activity. Collapse doesn't mean recession, but that it just grinds to a halt. When you talk about the consumer has been extremely resilient. Well, the reason the consumer has been resilient, a lot of that has to do with the transfer payments from the government. It really helped. We needed it over a short period of time. It probably lasted a little longer than it should have, but it is what it is. When I look at the inflation right now, we just got CPI today. It was 7% for the calendar year of 2021, which is a number that most people haven't seen. In fact, that headline number, it's greater than every data point back to 1982. So it's been 40 years practically since we've seen that type of data. But the inflation, it's been a lot of goods inflation. So as we know, that's driven by the supply side of the equation. Everybody's heard about the constraints on the supply chains, but it's also been this consumption that we had out there where we changed our dynamics. People worked from remotely. They needed more things around their house because they were spending their entire life there. And so what we haven't seen is the goods prices come down whatsoever. They continue to be very stubbornly high. And if you'd asked me about a year ago, I thought there had been this handoff from goods to services. People would be out doing activities again. We've seen services inflation come back to pre-pandemic levels, but the goods side remains significantly elevated, which is why you're seeing such high prints in CPI. So the good news is that the supply chains should help. The port congestion should get relieved in the next few months. We're hearing stories about the semiconductors and the chips that we need for all the computers and cars is going to get back online. Ford's talking about production coming back to pre-pandemic levels by the end of the year. So these things are going to resolve themselves. So that means the goods prices, the pressure from that side of the inflation should subside. Now, it'll still be there a little bit, but it won't be in the magnitude we've seen. However, the bad news is service inflation is likely to continue to creep up. So it's going to take some of that goods inflation, it's going to translate into service inflation, and it's primarily going to be driven by the housing market. The housing data inside of CPI operates as a lag relative to the other markets. So we haven't seen those 20% house price gains or the 9% and 10% rent inflation in the true actual inflation data yet, because they're smoothing, their surveys, there's a lot that goes on in there. So that's going to continue to press upwards. So that's where we think that inflation this year still runs north of 4%. But that's a lot better than 7%. And if wages kind of track where they have been, at least wages will be growing in line roughly with that inflation. So in general, the consumer still seems to be in relatively decent shape, but we're going to have to see how the next couple of months play out as a lot of these extraordinary programs ran out either back in October or at the end of December. And so that's kind of the wild card for now. But when I look at the jobs market, it has been extremely healthy. A lot of people are disappointed with the jobs report from December, only having 199,000 jobs created. But if you look under the surface, what you saw was that these jobs were in better sectors, higher paying. You look at the JOLTS data, which is job openings. We have almost 11 million jobs that are open right now. So that means there are ways for skilled labor to get out there and do this. If you look at job quits, you actually saw this in white collar workers were a significant piece. Yes, leisure was a big piece last month, but white collar was there too. So there's a lot of things to think that labor is accelerating in power, which leads to very good attributes for the ultimate consumer. So I'm less dire on the consumer than a lot of other people out there, because looking at the job market, it really looks like it's pretty healthy and robust at this point in time.
So shifting to the F word, what do you think DoubleLine's view on the Fed and Fed policy for interest rates in 2022?
Yeah, I saw what you did there. I was worried about my compliance, but a lot of people do use another F word when describing the Federal Reserve, right? But that said, I think Chairman Powell, he's doing the best he can. But they are worried about inflation. And I think something changed back in November, and they call it the Powell pivot, because alliteration is something we like in finance. But what happened is that Powell was just not worried about inflation. It was transitory. Then one day he woke up and he said, I'm concerned about it. And he said, even in his last press conference, he himself was concerned, not the committee. He stresses the committee all the time. He said he got concerned. And it happened to coincide, Jamin, with the day he got renominated by President Biden. And, talking to some experts about this, the belief is that Biden is very concerned about inflation. He's concerned about his approval rating. He's concerned about midterm elections, and inflation is on everyone's mind. Well, why does that matter with the Fed? Because the Fed, instead of trying to support asset markets, I think right now the Fed is going to try to fight inflation. And what that means is that they may get a little too aggressive with their rate hikes. A couple of weeks ago, you had interviewed me. I just said 3 rate hikes this year. It starts in June. It goes quarterly. They hike quarterly until they break the system. That's what they do. They're very good at breaking the system. And that's kind of the path of least resistance. I think we can do it, right? I think the markets can take it. It's set up. It's relatively priced there. Since then, now the bond market has roughly 3.5 hikes priced in. And I'm beginning to think that there will be 4 hikes this year. I think the quarterly hikes start in March. And it's because of what I just told you about the administration. They're concerned about midterms. They're concerned about inflation. You listen to Chairman Powell testify in front of Congress yesterday. That is what they are grilling him on, fighting inflation. So at this stage, I think that the Fed is in a 4 hike camp this year. The market's practically priced there. So what does that mean? Well, that means that it shouldn't be too disruptive to markets. The bond market's tuned into it. Now, the thing that concerns me, though, now is that it was in the Fed minutes that we saw from the December meeting. They came out last week, and in there, it said they were talking about reducing their balance sheet, what we call quantitative tightening. So when they buy bonds and expand the balance sheet, we call it easing, so it's tightening the other way. They're talking about letting these securities roll off into the market. And so they don't have a plan. They haven't said anything yet. But now I see pundits out there talking about the balance sheet roll-off's going to occur in the 4th quarter, potentially sooner. There's been some Fed governors that said it happens over the course of the summer. I think that's problematic with the rate hikes because it's double tightening. Hiking rates is a tightening policy. You're trying to tighten everything. You're trying to incentivize people to save versus, and increase borrowing costs, right? Reduce some liquidity in the system. But as they reduce the size of their balance sheet, what happens there is that, let's say they're treasuries. Well, if they're treasuries and they roll off, well, we don't run a surplus. We have to find something which means more treasuries. But now the Fed doesn't buy those treasuries back. So now you've disrupted the supply-demand balance of the marketplace. So that will put more pressure on rates. Now, potentially, that's what the Fed will want to do if inflation remains stubbornly high. And we think that this has not been the peak in inflation. We think inflation peaks the next couple of months. So we still think you can get to like a 7.4-ish or 7.5% CPI print. So the sevens aren't behind us yet, right? Because we have low numbers rolling off the next couple of months. However, if it stays at that level, maybe the Fed starts to let the roll-off happen quicker on their balance sheet. And I think that could be a little problematic. It'll be problematic for yields, meaning yields will go up, but it could ultimately result in being more problematic for the overall economy and risk markets. But again, don't underestimate the power of midterm elections. And I do think that that's part of what's really changed the dynamic inside the thinking of the Fed.
Continuing the conversation of the Fed, you've interviewed Danielle DiMartino Booth a couple of times on your podcast.
Yes.
And her book, Fed Up, has been critical of the Fed.
Yes.
Looking back, what could have the Fed done differently?
Well, I just saw Danielle last week. We hosted an event here at the DoubleLine offices. Well, I'm not at the office today. I'm working remote, but we hosted an event with her and some other, thinkers, and we were talking about some of this. And really, I think the Fed just stays committed to these policies for too long. And so, did they need to cut rates to zero in March of 2020? Absolutely. Do they need to step in and do quantitative easing? Absolutely. But did they need to continue it for another 2 years? Because ultimately it will be 2 years by the time they stop buying bonds. So I think in this cycle, at least, what the Fed has done is they've been too loose with the policy for too long. We could have reduced the purchases significantly sooner, and you wouldn't have had this pressure to raise rates. So I think usually what the criticism of the Fed is they're usually behind the curve. And in this case, they fell behind by being too loose for too long. And I think if you go back to the Greenspan era, that's what they'll say about the maestro, right? He was too loose for too long. There's this hubris and this overconfidence that comes through central bankers. And I don't know, it's because they're typically raised in academia and they have that as well. But the Fed's just an amalgamation of a bunch of human beings, right? They're trying to make the best decisions they can. But I think it's sometimes they get scared of their own shadow, and they get wedded to their models. And so I think, having more real world experience, I think that's why Jay Powell is a good person there. He has experience from credit markets. But it's a tough job. I mean, who would want it? It doesn't pay enough, I don't think, for the criticism and everything you have to deal with. You get the label of the most powerful person in the world, but it seems like a thankless job to me. So I can't cure what the Fed can do overnight, but I respect Danielle and all of the work she does as well.
I appreciate the perspective. So shifting gears a little, I mean, you have a great podcast. You get a lot of interesting people that you get to interview. And you had a recent podcast regarding cryptocurrency. And was just wanted your thoughts and outlook on crypto going forward.
Yeah, it was one of those where I had the podcast not knowing what to think. And I learned a lot of great acronyms like HODL, the moonshots, that was what on our research we learned about too. But I just, I have empathy towards the people who are all in on this trade. And, I think it deserves to be looked at. I don't know what the use of all these things is going to be. But the technology is fascinating. And, look, it's speculation, and speculation can be rewarded. And so a lot of people have crypto riches, as they call it. I'd heard about Lambos before, crypto riches and HODLs. Those are things we had to learn about. But I think that, the technology has merit. Whether or not it's a good investment or not, I don't know. That's the thing I can't get my mind around. Remember, I work for around a bunch of bondos. We look at cash flows. There's no cash flow. I see gas fees. I don't understand the forking mechanisms. I know I'm going to get a lot of feedback on this now, and everybody's going to try to teach me how to do it. But I think that the technology is amazing. I think there's a lot of great efforts behind it. Whether or not it has value or not for the long term, I just don't know. So I do have a couple of cryptocurrencies or little crypto tokens from some of my fantasy football days. So I'm a hodler there. But unless these things go astronomical, it's not going to be crypto riches for me.
So for our audience, can you explain what a Lambdo is?
A Lambo, Lambo. Yeah, it's a slang for a Lamborghini. So that's what all the crypto bros, as they call themselves, were out buying Lambos. So every time that Bitcoin would go up, That's what a Lambo is.
No speculative frenzy there then, right?
Not at all. Not at all. I mean, whenever you're taking your proceeds, and look, think about it. If with the benefit of hindsight, let's say you cashed out your Bitcoin. Let's say you did it like 40,000 a year and a half ago, and you bought this Lambo, and you bought it used, right? You're up. You're up on the Lambo. Look at used car prices, right? So sometimes that luck can be a lot better than having the skill to really think about it.
So on a serious note with crypto, thoughts on the blockchain and how the blockchain can change even financial services.
Yeah. Well, I mean, we've seen a lot of ideas about different, applications, whether it's, mortgage registry or verification of identities. I mean, there's a lot out there. I think that it's very useful for it. However, just because it's a useful technology doesn't mean that ultimately you make a lot of money off of it, right? And people joke about Netscape, right? When you go back to the internet wars, and Netscape ruled everything. I think now, like the native browser was called Mozilla. It's buried under like Firefox or something like that at this point. So the early adoption is something that I think it has a lot of merit. I think the innovation you see there and what people have created there, but with any speculative asset, there tends to be, some bad players, right, within there. And so there's going to be people who are unscrupulous, that are going to drive, some of this, bad behavior. But the blockchain does seem very interesting. I just wonder what happens when it gets so large, right? We always talk about computing power and the ability to do it. If every transaction, everything that's ever occurred since the inception of it is on there, I just think about my computer that gets slower after we're using it for a year and has all this data on the hard drive. So that's the one thing that I kind of scratched my head about. But I guess if it's distributed out in the computing power, there's ways of getting there with Moore's law. But definitely it's fascinating to try to, change that. And to what I'd like to see, let's get the settlement times down on securities. Right, this idea that securities take 3 days to settle. Now we're pretty much T+2. There's still pockets of the market T+3. Bank loans, in a great market takes 7 to 10 days to settle. In a bad market, it takes a year. Like matching these transactions up shouldn't be that hard. I think that's a natural extension of the blockchain. And believe me, I didn't come up with this idea. I've heard it from others. But I think those are the types of things that it can be very helpful in. And, what it does, though, it reduces a lot of people's jobs. Like I think about the mortgage industry, how, if you've ever done a transaction on a property, the title, right? The fact that you have to clear the title, how hard is it for someone to figure out who owns this property, right? The blockchain can tell you instantly, right? And why do I got to pay $3,000 so someone can run the title on it, right? It doesn't make sense. So I think there are very, very natural extensions. But remember, there's also barriers to entry because think all those people that work for title companies that don't want it, right? They want to keep their protection. So I do think there's some interesting things, and I'm sure there's many that we haven't even thought of today.
So if we look at COVID and what's happened the last 20 months, are there any long-lasting trends from COVID that the market is currently underappreciating?
Ooh, currently underappreciating. Well, I think that the world changed. When we look back, and it's a horrible kind of comparison, but I think of it like 9/11. 9/11 changed us, right? It changed the way we travel, the way we operate, the way we think about things. And I think COVID is one of those as well. And so I think there's some negatives there that I think the market doesn't appreciate. What's happened to people's psyche, mental health. I think those things will be with us a long time. But I think also this idea that we're never going to go back to offices, that we're going to be doing Zoom and stuff like we're doing today forever. I think that is something that just isn't going to happen. The human spirit, it craves interaction. And so I do think that we go back something to what we saw pre-COVID, but it will be different, And so I think from the perspective of the trends, I think the market's thinking short-term about COVID, right? What it's doing, it's saying, okay, whatever's happening right now, it's going to be forever. And that's the way the markets work. But I think the risk that's underappreciated is that we go back to something that looks like the previous world. It'll still be different. But I think that's one thing that's kind of underappreciated right now is that we're going to go back to interacting. Like when I first started my career, I heard that we're going to have this paperless office. Paperless office. Everything will be digitized. And, we're 22 years later, I guess. And I still have paper sitting in front of me right now that I write on, right? We still print stuff out, like trade tickets still come out, out of the printer. So, there's just things that we assume is going to happen. It was VTEL, like Zoom before it was Zoom, right? There was going to be no client meetings in person. We're going to do it all here. Think about all the carbon emissions we save, even though we didn't talk about that flying. That was not the case. If we do business, we do deals, we go see somebody, right? And I don't think that changed. So I think we go back to that. I think that's underappreciated right now.
Yeah, that's great feedback. So shifting gears, just to learn a little more about you personally, what's a life lesson you've learned that you wish you learned earlier in life?
I don't know. I mean, that's a really a tough one. You kind of stumped me there, but you're always learning, you're always evolving. So I think that's one thing you want to do, but I think it's to, really just listen to other people and respect other people's opinion. And it's not that I think I was dismissive, but, as you're learning, especially when you're in academia, it's always, there's one answer. And what I've learned over time is that, there's multiple ways to attack things and there's multiple viewpoints. And maybe COVID is one of those things too, where, it's having some empathy and understanding the other side. So I think that's something that I probably should have jumped on sooner. And I don't know when it switched. But I want to think it's getting older and wiser that it was there, but it's something I probably would have appreciated earlier in life.
Yeah, I've been told the empathy gene's lacking in me, so I wish I knew that one earlier.
Yeah, well, if you ask my family members, they may think so. They may say give you a similar answer. So
yeah, well, there's two of us, right?
Yeah.
So outside of your family and work, do you have any favorite activities?
I enjoy sports. I've gotten to the age where I don't play them because it's nothing but risk. Yeah, I don't see the return aspects to it. It's more of a risk. I'm a big baseball fan, so I enjoy like going to a baseball game. Having a hot dog and a beer. That's just great. To me, that's Americana. That's summertime. That's great out there too. And I've been trying to get into golf. It's hard to do, but that's my latest COVID experiment of trying to get some outdoor activity and being able to do something somewhat by yourself with a couple of people. And I don't know if that one's going to stick, but hey, it's my 2022 resolution to try to get out and be a little more active.
Love it. So iPhone or Android?
Android all day long. I hate the iPhone.
Oh,
I'll go on a rant here if you have time. But the reason is I hate the planned obsolescence. But the thing I hate the most is their infrastructure. How they wedge you to it. There's no the customization's limited. They want you trapped in there. And I also hate how everything is proprietary on their plugs and everything. I love that the EU regulated them on that, that they have to use the USB-C standard. It's just been so annoying. I've hated it at least my entire adult life. I've hated everything associated with Apple. So there's probably a lot more hate mail coming your way, Jamin. Why'd you let this
That's okay.
Yeah.
I learned something new. I didn't know the USB-C was an EU standard that Apple.
Well, I think they're moving to. I think they're trying to. It's by 23. I think that they're forcing everybody to have the same standard because it's mainly for trash and emissions, right? That you change the standard all the time. And again, it will evolve, but that's something that I always like. Why do I need to pay $40 for a plugin when it's $2 for this basic wire, right? It doesn't make.
I agree.
Yeah, there's a reason that they're a $3 trillion market cap company.
Yeah. So what is your favorite app for following work type stuff? And what is your favorite app for personal?
Well, work stuff, we all live with the Bloomberg, the Bloomberg app. It works well on Android, just so everyone knows too. In fact, if anybody has a Bloomberg, the B unit that you have to use to log in, instead of having to carry that thing around, they actually have an app for Android. You can log in. It's much easier, but they don't have it for iPhone. So I just want to point that out. Usually Bloomberg develops for iPhone first, but so that's one of my favorite apps out there. Also, I use I use Twitter a lot too for news feeds too. So the tweet.
So outside the double line, who are your 2 or 3 favorite people you like to follow on Twitter?
Well, I mean, I get a lot from Jim Bianco, out of Chicago. He runs the Bianco Research. He was at our roundtable last week. Danielle always puts out good stuff. You mentioned her, so I'll put that on there. I follow a few comedians and stuff like that. You gotta keep some levity in there as well. If you want some comedy mixed with finance, liquidity. It's like liquidity, but LIT quiddity.
Yes, I have.
Yeah, he was killing the memes last year. Some of those are just classics already.
Yeah, I'll have to look at that one again.
Yeah. So and again, there's a lot of people on the econ side that we follow too. But I'll send you a list after the fact. Personally, I mainly I don't tweet. I have the account for the Sherman Show pod where we put up stuff related to the podcast, but I'm not a tweeter. I'm not a social media person. And I'm just more of a curator of news and trying to get, information the best way I can get it in.
All right. Last couple questions. Do you read the physical newspaper or digital?
Digital. All day. I don't have any paper or physical subscriptions to anything.
All right. Food section or entertainment section?
What was the first one? Food
section or entertainment section?
Man, you got to live with food, but you need to be entertained. So they're neck and neck with each other. But, I have an appreciation for food. So I'm going to go with food over the entertainment.
All right. Live sports or binge watch a TV show?
Live sports.
Okay. And
I hate that part of the year
one?
I hate that part of the year when football's done, and I'm not a huge basketball fan anymore. So I really have that stretch between the end of the end of the season in football till, baseball starts, but definitely live sports.
Sneakers or dress shoes?
Well, sneakers, because we're living in a casual world, but I still don't mind getting dressed up on occasion. You're looking good with your tie. I kind of miss the suit and ties every once in a while. So it was nice to go to the holiday party that we had at DoubleLine. We fortunately had it earlier in the season before Omicron really broke down. And it was good to see everyone dressed up in black tie again. So I have an appreciation for the loafers, but I prefer the sneakers on a day-to-day.
All right. Morning workout, evening workout, don't work out.
I mean, everyone's going to laugh, but it's mainly don't work out. That's why I'm trying to get out there in there, morning is coffee, news, I work better in the morning. And then usually in the afternoon, if anything, that's why I'm trying to adopt this golf thing, try to get a little exercise and at least act like I'm working out. So.
Well, thank you, Jeff.
Absolutely.
Thank you for our clients.
Yeah. No, it's been a pleasure to get here to talk about inflation, binge watching sports, my hatred of iPhones and everything else. So it's been great.
All right. We'll keep a positive attitude and be amazing.
Okay. Well, we'll try to do both. So thanks again, Jamin.
I hope you enjoyed today's interview and gained some perspective and insights on Jeff and DoubleLine's investment strategy. We look forward to sharing future Money Manager insights.